Hello, and welcome to our Asia Trade Floor update with Portfolio Manager Stephen Chang. Today, we'll be discussing the latest developments in China and what they mean for investors like you. Let's dive right in. Stephen, the opening salvos of the renewed U.S. China trade tensions have been fired. How will this impact the U.S. economy?
Indeed, an additional 10% tariff across all China imports into the U.S. came into effect on the 4th of February. China responded swiftly with tariff of 10 to 15% on targeted U.S. imports, as well as other measures. We expect the U.S. tariff on China will be durable, given the ongoing geopolitical tensions between the two nations, including issues around Taiwan, trade, intellectual property, and technology. We think the additional 10% tariff on China will be less disruptive to the U.S. economy compared to those on Canada and Mexico. As the U.S. has fewer supply chain links and less domestic content in Chinese imports, the latest U.S. tariff announcement on aluminum and steels adds another wrinkle. While the outcome is highly uncertain, we estimate that Trump's tariff, if fully implemented on China, Canada, and Mexico, could raise U.S. inflation by 0.8 percentage points and reduce growth by 1.2 points in the first year. If just the Chinese tariffs are implemented, the economic effects on the U.S. would likely be much more muted, boosting inflation by roughly 0.2 percentage points with a similar size negative impact on growth.
What about China? How do the tariffs impact its macroeconomic outlook?
U.S. tariff will put pressure on China's already strained economic environment. China's property market remains a significant drag on growth and perhaps needs more policy support to turn around. China has been reliant on an export-led growth model due to its weak domestic demand and property sector challenges. Therefore, it is likely to continue to ramp up monetary and fiscal programs designed to support its domestic economy. Consumption, in fact, tops President Xi's list of 9 economic priorities for 2025. To spur spending, for example, the government has plans to expand its consumer subsidy program to include electronics such as smartphones and tablets, as well as vehicles and home appliances.
How about infrastructure and manufacturing, which have been helping to drive China's growth in the past few years?
We think infrastructure investment might slow due to the local government debt constraint. Meanwhile, manufacturing, particularly in semiconductors and other technologies, will continue to receive support. However, export-oriented manufacturing faces risk from tariff and global trade tension. Overall, China's economic landscape is complex, with various moving parts influencing growth prospects. In our base case, we see China's real GDP growth ranging from 4 to 4.5% in 2025, down from 5% in 2024. We expect this growth will be supported by a fiscal stimulus of 1 to 1.5% of GDP. In addition, we anticipate gradual policy easing to encourage borrowing and investments.
What spillover effects does China's outlook have for the broader Asia region and the rest of the world?
We have analyzed 3 scenarios along with our base case that I just mentioned. First, in the unlikely scenario of no direct stimulus, growth could drop to 3%. This would significantly affect countries with strong ties to China, such as Korea, Malaysia, Thailand, and Australia, and place negative pressure on commodity prices such as oil and metals. The second scenario is extra fiscal stimulus, where growth might reach 5%. A consumption-driven stimulus could benefit agricultural exporters like Brazil and New Zealand. Conversely, if the focus is on investment, the spillovers to the world will likely be larger. Commodities might see a boost, as well as economies more reliant on Chinese investments, such as Taiwan and Vietnam. The third and final scenario sees China doubling down on manufacturing, with a growth of between 3.5% and 4.5%. This may intensify global competition, however, leading to greater losses and therefore higher subsidies for less competitive Chinese firms. Overall, the situation is very fluid and we'll keep a close eye on developments.
Yeah, that's consistent with what we highlighted in PIMCO's latest cyclical outlook. Uncertainty is certain. With Trump 2.0, China's challenged economy, and elevated geopolitical risks, how should investors think about their portfolios?
Amidst this uncertainty, we continue to see opportunities in Asia Pacific fixed income markets. To capture short term volatility, active investor can explore a broader set of markets and instruments in order to extract structural inefficiencies and differentiated pricing created by market headlines. However, as countries respond to both domestic pressure and external influences, we think investors should maintain a diversified set of positions and prioritize flexibility in their portfolio positioning.
Thank you, Stephen, for sharing your insights. And thank you all for watching. To find out more about our outlook for Asia Pacific region, please visit pimco.com. Thank you again. Until next time.